Happy Tuesday and welcome to another morning live with Real Estate Mindset. I am so happy to be here with you. Sorry that I'm starting a little bit early, 7 a.m. We're starting almost 2 hours early today because after this live, you guys, I get to go hammerhead shark fishing. It's catch and release. And I do plan on doing a documentary style video. Super excited. As soon as this is over, I'm going, man, and I'm really looking forward to it. I hope you guys had a great 3-day weekend. Want to say good morning real quick to my buddy Raymond. Raymond, we love you, brother, and good job doing work out there, not just purchasing real estate with your emotions. This guy is working hard to find great deals. Good morning as well, YouTube. Good morning, Maverick. Appreciate you and your support, brother. Nikki, it's always nice to see you. I see you on Twitter as well. Brad, good morning. There's my man, Vovo. I see you all the time, Vovo. You're number one always, bro. I appreciate you. We are blessed. Look at her name, you guys. There's still good people out there, and a lot of them are part of Real Estate Mindset. I love it. Good morning, Andrew. We're going to get started right away, you guys. I know I'm a little bit early. That's okay. Don't forget, everything will be chaptered in the description if you guys want to go to a certain section of this live video. And I wanted to remind everyone why I'm doing the lives, okay? So remember, well, actually, why I'm doing the lives and why the channel of Real Estate Mindset even exists. It's to help keep you guys, number one, patient. It's to help get you guys strong. It's to help make you aware. It's to help turn you guys into strong consumers. If through this channel, you're not becoming a strong consumer, then I'm failing. Okay, so that's why we're doing this. I hope you guys enjoy everything. And where we're going to get started, you guys, is let's take a look real quick at the economic calendar, which is right here. So I can tell you guys what is happening this week. And I should be back by Friday morning. I'm not 100% sure. Actually, I may not be back by Friday. I may still be on the beach. There's going to be a horrible storm as well. So I'm going to get beat up on this trip, but I love it. But on Monday, you guys, obviously Memorial Day. So today's Tuesday. We're going to have Case-Shiller come out. Obviously, Case-Shiller is super lagging, but it is expected to show, obviously, year over year growth of 7.3%. It says right there. Now at 10 a.m., this is all Eastern time. Consumer confidence is coming out. So I highlighted that as well. Now on Thursday, Wednesday is just, talking, if you guys are interested in the talking. But on Thursday, we're going to have the initial jobless claims. We'll have the GDP first revision and also pending home sales. Now, on Friday, we have the PCE. So look out for all those things. Now, let's start with the 10-year Treasury. Obviously, the longer end of the Treasuries affect mortgage rates. Okay. That's why we're tracking that 10-year Treasury. We're elevated. We lost some steam over the last couple of weeks, but I will also say that we have, I think it was from, what was it, FHA or Freddie Mac? I don't know. One of them just came out with basically a forecast of interest rates, and we're going to be having high interest rates for quite some time. So I don't know what's going to happen here. This is probably, we're going to be anywhere from, 4.4 to what, 4.8 to 5. Who knows what's going to happen next? But either way, as far as mortgage rates and interest rates being elevated, they're here to stay. Absent stimulus or having to stimulate the economy due to something like recession, this stuff is going to be elevated. In fact, you see it already going up, whereas it actually started out the day kind of balanced and then went down. What did it go down? About 3 basis points, and now it's back up again. So very, very interesting. Now, let me show you guys the impact that's having on residential mortgage rates. So still elevated, greatly elevated from where we came from. Historically, no. Historically, this is not elevated interest rates. What is elevated is the prices. Okay, it's the prices, it's not the interest rate. But right now, you guys, for conventional mortgages, that's what you see right here. This is what most people get. So most people get this conventional mortgage right here, and it does have higher interest rates, 7.16 average. Now, if you have great credit, if you're shopping your loan, remember, usually broker's better than a direct lender. You should be getting, in my opinion, a half a point less than what you see here. So for example, I get probably close to 75 basis points less, but I know a lot of people, I know where to go and things like that, but you guys should be getting a half a point less. So I could probably get a rate, like if I want an FHA, I could probably get a rate in the high fives right now. So very interesting. And you guys notice that FHA is the lowest rate for today anyways at 6.7%. So you have a lot of gap right there as far as it's cheaper as far as interest, but mortgage insurance, FHA is generally higher. VAUC is slightly over FHA. Jumbo is out of control. Jumbo is sitting at almost 7.5%. So it's like, man, how are people buying in California, on the East Coast, on the West Coast? Like they get hit the hardest on the interest rate if they get a loan. It's crazy. Now, 15-year is matching a 30-year. Now, 15-year is a great loan, you guys, because the way the amortization schedule works, you pay a lot less interest on a 15-year fix. But the problem with that is, for a lot of people, is you're locked into a much higher payment. So you can actually turn a 30-year loan into a 15-year loan without being locked into the payment. Now, as far as what's going to happen next with interest rates, take a look at this, you guys. We've had some pretty crazy movement. This is CME Fed Watch tool. This is showing us what the market is baking in, basically baking into the numbers as far as what's going to happen next with interest rates, the federal funds rate. And this, they're always wrong. This is a very bad forecast, but it is interesting if you want to see what's kind of in the minds of investors and in the market. And you guys remember, I think the last live we did, they're now, I don't want to say pricing in because it's only 0.1%, but they have now basically started pricing in an additional rate increase. And if we go here to June, it's not a lot, okay? But look at, for June, it's 0.9%. You guys see that right there. Now, what's interesting is, take a look at this. It doesn't even go away until April of 2025. So the market, okay, listen to me, until March of 2025 is leaving a little bit, maybe there's going to be a rate hike. Probably not. More than likely not, but there's still, at least they finally have it reported. And that's what you see right here, that 550 to 575 that you see right there, that represents 25 basis point rate increase. But look at what's interesting. Let's go back to December. Let me show you what the market's pricing in as far as like what else. So the market's now pricing in a 17.3% likelihood of no rate cut. Do y'all remember the video that I made before all of this that I said no rate cuts this year? People were calling me crazy. But I was like, why would they cut rates? If they cut rates, it's to stimulate. These are just historical average interest rates. This, again, it's the prices that are so bad. But they are saying overall, one rate cut, 41% chance of a quarter basis point hit. Okay, I'm sorry, a reduction, which basically does nothing except affect sentiment, right? Now, they're also saying 32% chance for 2 rate cuts. They've basically taken 3 rate cuts off of the table. But again, you guys, I say off of the table, but they have no control. Well, I almost said they have no control. But this is very, very foolish forecasting. But I did think it was interesting. Now, again, as consumers, I want you guys to be sharp. I want you to be strong. Okay, so I am taking you once again to an amortization schedule. And again, I'm going to show you how to turn this bad boy into a 15-year loan, but you don't have to be locked into your payment. Working your amortization schedule allows you to take a 30-year loan and basically turn it into a 20-year, 15-year, 10-year, 25-year, whatever you're comfortable with paying. And the way you do that is you just put more money towards principal. If you don't do what I'm saying and you pay this loan off for 30 years, you end up paying more than the amount that you borrow. So if you borrow $324,000, you get a rate of 7.16%. You guys pay back $788,000. The fees are $464,000. Do you guys see why the market is so bullish? Look at how much money they make. I want you to think about this for a second. Again, your loan is for $324,000. That's your loan, $324,000. But just your interest is $464,000. That's why the problems in this industry, you guys, everyone's trying to take the money out of your pocket. So you got to beat them down. You got to beat them down, or they're just going to keep this show going. And the problem is most people don't care like you guys care. You guys are up early. It's 7 a.m. Central Time, 8 a.m. Eastern Time. You guys are up early, kicking butt. You should be proud of yourselves. I'm proud of you. I'm proud to be part of this movement, real estate mindset. It gets me pumped up to be part of you guys. I mean, I feel so good because sometimes I feel like I'm crazy. Like, does anyone else see this? Like, is anyone saving money and trying to get ahead? Am I the only one? I'm not the only one. You guys are as well. Now, if we put extra money every month towards principal, guys, give me a number. Give me a number. I want to show you the impact. If you guys can, in the comment section, just give me a number to add towards principal. Give me a dollar amount. I'm going to show you guys the impact of paying extra money towards principal. And remember, you guys, $7. Okay, fine. Man, Johnny, you know what? Let's just do $7. Okay, because who can't afford $7? Let's see if $7. I have no idea, actually. This is interesting. All right, so let's see what the impact of just $7 does. Okay, so we're just going to pay $7 extra per month just towards the principal. I have no idea, Johnny, what this is going to do. Okay. Okay, so if you pay $7, only $7 a month, you save 3 months. Okay, You guys saved 3 months and $6,200. Look at that. So if you guys, if you pay only $7, you still pay, you save $6,200. So, again, $7, you to save $6,200. And the beautiful thing is, that $7 is yours because you're just paying down the principal. So it's still your money. And I really want to encourage you guys, come here if you want to really kind of just analyze your market. You remember me just preaching and yelling like how important real estate is locally? Well, being aware is that first step. Okay, so you're aware now. Real estate's about local trends. But then what? Where's the action? Well, the action is when you stop listening to this video, do some research. If you don't have access to MLS and you're in a disclosure state, go to Zillow and go get my subdivision analysis form and start filling that out. But also, you guys start playing with this. Let me get this comment off from Johnny. Johnny. But also come here, okay? I went to Google and I typed in mortgage payment calculator, and I checked this box here. This allows me to put in my taxes and insurance. But this is gonna let you get a general idea of how much it's gonna cost to buy a house, okay? So you would put your loan amount, or say the price right here of the home. Say the price is $350,000. Say I'm just gonna do the minimum down payment on FHA of 3.5%. Now remember, I said that if you've been listening to me, your rate should be a half a point lower. So if it says 6.7 right here, so it says 6.7, but at half point lower because I've been listening to myself, I can get a 6.2. And this is just hypothetical. I'm not quoting anyone. I'm just hypothetically. So I'd go back here and I would put 6.2. First of all, the interest, just such a difference. And then I go down here, guys, and I play with the property taxes. That's why in my subdivision analysis form, there's always property taxes, because that's very important. And that is not a fixed fee unless you're a veteran in Texas on 100% disability. Then you don't have to pay taxes. So Texas does take care of the veterans. I love it. And then put your homeowner's insurance, and then it should automatically calculate your mortgage insurance. But my point here, this is what a loan officer, this is one of the things that a loan officer does and why you need them. And you guys can do it yourself. Always go to a loan officer, like I say, guys. But again, you guys could do this yourself. I want you guys to be super strong. And let's move on now to our first video. So we're going to do our first video now. Do my quick timestamp. I appreciate you guys. Any comments? Good morning, Night Cry. Appreciate it. There's my buddy Johnny. Let's see, Clark. We got a realtor, my buddy Clark in here. Hey, Clark, you being a good realtor, man. You take care of your clients. You empowering people. I think you are. I'm going to tell you guys, I'm impressed. The realtors that stick around and to this channel and learn and grow, I'm impressed with them, because it's not easy to get criticized. It's not easy at all to get criticized. But let's go into our first video, you guys, which is basically, sorry about my cell phone. Oh my gosh, stop it, cell phone, stop it. We're going to go into our first video. Let me know if you guys don't mind that the audio is okay, and enjoy.
The future direction of interest rates, we want to bring in Allison Schrager. She's senior fellow at the Manhattan Institute, and Brookings Institution's senior economic studies fellow, Wendy Edelberg. Welcome to both of you. Let's kind of start where Rick just left things. And Wendy, this is one piece of information in a much larger puzzle that we're trying to piece together. But do you agree with Rick's general assessment that it's going to be a lot tougher for the Fed to raise rates? The market can be pushing back, and there are big issues we need to be watching just because of what it means for our ability to issue debt.
I think that monetary policy is being set with an eye to what's happening to inflation and what's happening to the labor market. I think monetary policy makers are doing their job irrespective of what it means for the cost of debt financing. Now, what they are paying attention to is how much pressure federal borrowing.
You guys, real quick, I'm so sorry. The content creator in me, I have to say something. Her ISO is way too high. This saturation is awful. I'm so sorry to say that.
Is putting on interest rates. And what that means is that the higher the interest rate is, because the federal government is in there competing with other borrowers, the higher that interest rate is, the more monetary policy makers have to raise interest rates to make sure monetary policy is tight. And right. So I think the direction is the higher the more federal borrowing we have, the more monetary policy makers have to raise interest rates. I think that's the direction of causality.
And Allison, in the meantime, as that's happening, how do you see the consumer shaping up on things? How do you see businesses shaping up?
Well, it seems like every piece of data we're getting each week is saying the same thing, which is demand is still really high in this economy. And as I said, we see this with the sort of bigger orders. We're going to see this with the consumer sentiment that's coming out in a couple hours. It just seems that we're in a really hot economy. And that means that I think with every data report, it seems like the odds of a Fed rate cut is getting lower and lower. And when it comes to interest rates, when you, Rick, have made some like really important points here. And I also want to add that as inflation gets stickier, it also starting to feel higher and more unstable. And that means rates like the 10-year rate are just going to be higher because the term premium, it's been a while since we've really had to think about the inflation in the term premium because inflation was so low for so long. That gets baked in too, not only expected inflation, which the report in a couple hours still expects to be above 3%, but the risk around inflation, like an inflation risk premium also gets baked into the term premium, which means anything above 5 years, it might just be structurally higher for the time being.
I mean, is that okay, though, as long as the economy continues to chug along, Allison?
Yeah, it is. I mean, for most of, the last century, rates were definitely well above 5%, and we grew just fine. I mean, but it's a very different environment than we're used to. I think we have an economy largely built on very, very low, maybe zero real interest rates. So, I mean, it will be different, but there's no reason to believe that, it could be disaster either.
Yeah, I guess, Wendy, that depends on where you're
No
sitting.
reason?
There are going to be pockets
No reason? What
where
about
it
the
does
yield
feel
curve
disastrous if you've built your business plan or something else around the idea that rates were not necessarily going to be zero, but we're going to be a lot lower than we actually wind up seeing.
The real risk here is inflation expectations. So right now we have tight monetary policy, a very strong economy, and higher than desired inflation. Those things actually all go together and suggest that monetary policy just has to stay tighter for longer. That doesn't mean that we're in for a hard landing necessarily. What it means is that monetary policy still has more work to do. Strong economy, high inflation, those go together. But the risk.
And real quick, guys, do you know what also goes together with that? The deficit spending also.
Is if inflation expectations get stuck too high, then monetary policymakers have to cause some pain to convince everybody, no, we really mean it. Bring your inflation expectations back in line to what they were pre-pandemic. And yes, we will see what survey responders say when we get the Michigan survey. I really don't know what to make of the Michigan survey these days. It's pretty much a mess. Consumers say they're miserable and they spend like they're unperturbed. So, we'll see. But I think inflation expectations is the thing to watch.
You see how everyone's watching, or not everyone, but a lot of people are watching the expectations for inflation. Don't you guys find that like pretty interesting? I'm going to move on, you guys, to I got really no questions on that video, but I'm going to move on to our next segment, which is real estate segment real quick. And I want to just kind of confront a couple things. Now, I was really proud of myself, you guys, to get us to 100,000 subscribers. We interviewed someone that was bullish on the housing market. And then my first live back on 100,000, I debated one of the top leading bull analysts for the housing market. And I want you guys to know, to really think about this. Like, the reason I'm doing that is because, again, I care. And I want you to know, even you don't have to listen. If it frustrates you, it's okay. And the numbers on my channel show me that people hate it. Absolutely hate it when I bring people on my channel like that. But I have to tell you guys, I find it very refreshing because it allows me to know, like to push against a bull and know what they're saying. Like, okay, because I keep asking why. And that's what I'm doing by bringing these people on. I'm like, why do you feel that way? And I want you guys to know, talking to both Joe and Logan, the two things that I got, okay, the biggest holes in both of what they're saying is, number one, income. And neither of them could ever convince me that people are better off right now than they were in 2019. Neither of Joe or Logan, which, by the way, I appreciated them both. And I'm not talking smack. I'm just saying differences of opinion here, right? But neither one of them could explain to me the lack of income growth. Neither one of them could explain to me how it's sustainable. How could people continue to do this? At least I wasn't convinced. Now, the other thing that was the biggest hole, in my opinion, was inventory. First of all, there was many things, but those were the first two things: the inventory and the income. Now, let me explain why I appreciated this so much, because when I was talking to Logan, right, and I was pushing him pretty hard, he really threw up a lot of that bullish, like, this is why I'm saying this. And to his point, to Logan's point, what he was explaining is inventory is probably not going to be an issue, because if you look at the last 40 years, I think it was 45 years, inventory was, I did this actually, and I don't have to give you guys range, it's about 2.2 million active, okay? But the thing is like, okay, so I checked that data, but that data led me to the next thing, which is the decade trends. So the decade trends is not 2 million. The last decade, the average amount of active listings, 1.36 million. The last 10 years, the average amount of supply for houses, 3.7 months. And the fact that prices and the growth of prices exploding in like 2 years is so heavily dependent on inventory, I find it weird that the bulls no longer care about inventory. But again, their whole premise of price growth, supply, demand was inventory. So I hope you guys see that. I hope you guys enjoy it. I know I do. It makes me, my blood pressure gets up a little bit. My views tank. I put 3 times the amount of effort for 1/4 of the engagement. But I wanted you guys to know why I was doing that. And I also want you to know that I'm not scared. Okay, my very first debate was against Logan. Are you serious right now? Right? Who's been doing this for 15, 20 years? I've been doing this for 2 years. I'm not scared. I believe everything that I'm saying right now. I believe, not only because with all my heart, but not just because of my heart and my experience, because of the facts, the data, and what's going on historically. But you guys, I'm going to shut up and then we're going to move on. You got to find ways to try to appreciate what the other side of the coin is saying. Because, and this is what I'm saying, because you will find the why. And a lot of the times when I'm listening to these bulls, it doesn't make sense. And so that excites me. That helps me with my own opinion. You guys don't have to do it. I'm just saying, I will do it for you. But that's why I'm doing it. It's not like who won, who lost. It's like, okay, why are you saying this? And when I push you, what are you going to say next? Right? What are you telling people? And why are you saying it? So I hope you guys are getting that. I'll shut up. Okay, so let's move on to this. Okay, so this is a really interesting article. I'm going to be kind of brief here. This is cool. And then I'm going to show you guys inventory, and I believe you guys are going to be blown. Oh, what shirt is that I'm wearing? This is the Hey You Guys shirt right here. Okay, because I always say you guys. So I wanted to embrace you guys. This is you guys right here. Boom. That almost identical match. Anyways, so Cher's in here. I see someone. Okay, hey Cher. All right. This is a good article. It will be linked in my description. I'm going to cover this quickly and then we'll move on to our video. Who's to blame for the broken housing market? I like this article because it really kind of narrows it down into three culprits. Now, starting with, here's the thing I'm worried about. And I'll show you guys here in a minute. Let me take this off the screen. Starting with institutional ownership as a percentage of total inventory, okay? So this article is basically saying a lot of people think that the reason why prices, blew up and like, why is it the housing market broken? One of that is institutional investors. Now, this article, you guys, is painting a light on institutional investors that they only own 0.5% of single family rentals. The thing is, guys, is any portion of this giant pie right here is a lot. Even if it's 0.2%, that's a lot. And the thing is, guys, is it's a lot more than what this pie is showing, because they don't go and invest in every single metro area in the US. These institutional investors are picking pockets. So if we just look at the pockets they're picking, the piece of the pie is bigger. Okay. But again, when it comes to institutional investment of single family rentals, I want to see zero. I don't care if it's less than 1%, because less than 1% is still a lot. A little bit of a lot of number is still a lot. So again, I think they do a poor job at explaining this, but let me show you something else that I really want to put in perspective here. Okay. So what you guys are seeing here with this chart, let me put it a little bit closer to my head. Okay. Here's why. Okay. So you guys hear, the institutional investors barely own anything, but they've only just begun. So it makes sense that they only, what are you talking about? Only 1% of the entire stock? Are you freaking kidding me? You guys, look at this. They didn't even really start until 2012-ish. So this is a progression. It's not like they own 1% of the stock and then that's it. No, they are purchasing real estate like freaking lunatics and have only been basically investing for about a decade. That's it. And look at the trajectory, the dark blue. Look at it's iBuyers, the dark blue is iBuyers. Look at the trajectory. So it goes from almost no trajectory in 2012. See that? And then finally it starts to make some progress in 2016 and it starts to shoot up. But you guys, if you just think that there's no problem because they only own, say, 1% of the housing market stock, first of all, 1% is a lot, but also the trajectory of how they're purchasing real estate is astonishing. Again, it's blowing up. It's not getting better. So do you think that they're at fault? Do you not think that they're at fault? It's also trying to paint a picture up here that most of the investors are mom and pops. Okay. So they're also trying to say, no, it's not the institutional investors. It's you. You're the problem. Okay, guys, I guess we're well, actually, some of us are the problem because of how we spend. Okay. So number one, institutional investors, but take a look at this next thing. Okay. Now they want to blame, basically, there not being enough building. Okay. So it's actually very interesting. So a lot of people are saying, so Zillow and then the NAR rep is saying we're short 4.3 million homes, although we're only short 200,000, 300,000 active units. This is saying we're not building enough homes. Now, here's something that's interesting. I thought you guys would like this. So the number of homes added per person is actually going up. It's actually been going up, not been going down. So 1970, there was 0.76 houses per person added. Okay, this is adding. Fast forward to 2012. Let me look at this one more time. So for the last 50 years. Okay. So for the last 50 years, it's gone up. Actually, it's the highest it's been in the last 50 years. For every one person added, 0.81 homes are added. So what it's trying to paint a picture of is like it's upside down. We should have 1 for 1. But I'm like, well, there's like 5 people that can live in one house. But my point is like, be careful what narrative you're listening to, you guys. But I will say that if we did have a lot more new home building through the years after the GFC, we would be in a better situation, I believe. But nevertheless, they're also trying to say that it's the new home builders that's the issue. So we got institutional investors are to blame. For buying, we have new home builders are to blame for not building enough. But the third one, and the most logical, is the Fed. It's the Fed, you guys. Okay. It's obviously the Fed, but I want to draw your attention to this data chart right here, because this is very interesting, because I've been talking about and debating about the 30-year historical affordability averages. So over the last 30 years, here's what's affordable. Now, based on the current trends of housing affordability, this is stating, and this is a pretty cool chart. Come back to this article. This article is pretty cool. This is stating that in 3.5 years, we could possibly come back to natural normals. This is, well, I mean, I say natural normals, but like it's still going to be unaffordable for most people. It's going to be unaffordable. But it's like, at least it's like that line, because you see how affordable it was right here in this pocket. I mean, geez Louise, that's way more affordable. But let me explain to you guys what they're saying. So they're saying what has to happen is 3.5, and this is to people that are talking about real price crash. And the bulls are now saying there's going to be a real but not nominal. This is what would have to happen. Okay, so mortgage rates would have to fall 1% and income would have to grow 7%. Now, I'm not clear if that is every year it would have to grow 7%, or if in 3.5 years, because that's pretty much no growth at all. That's not even keeping up with inflation. So I think that that's per year, because again, inflation exceeds income growth. So I believe that's a 7% income growth per year for 3.5 years. I'm not 100% sure on that though. I would think so, but let me know whether or not you guys agree with that. So are we going to go through another 3.5 years of basically a broken housing market, where places in, like New Jersey have no inventory and still bidding wars, and places like Texas are going to continue to unravel, and Florida? I mean, holy crap. The housing market's so divided right now. It's really hard for me to even comprehend this. All right, so let me show you guys one other thing, and I think you guys are going to be happy about this. Now, let's talk about inventory. So now I'm going to talk about Redfin data, okay? It's all BS. All of the data is BS. I'm very frustrated about how all the data is BS, but listen, thank God we've been talking about for the last year subdivision analysis. because I think now you guys are starting to see like, yeah, they are manipulating the data. They just remove stuff. But subdivision analysis trumps that. If we can get access to comps, then we can figure it out for ourselves using simple math. Remember that, you guys. That's what I really want you guys to learn as well. Now, I went back last night in the middle of the night, and if you're in my Discord group, you saw this. It gets weird in the Discord group, but I'm going to be honest with you. I don't care. I'm a normal person, and I look at the Discord group is like, I'm just a normal person too, so I'm going to say some really weird stuff, and I'm going to do some really weird stuff because I'm a human being, and it just is what it is, you know? You guys, I went back. And I wanted to see how many metro areas that I could find that had more inventory than before lockdowns. So December of 2019, and I want you guys to know, I know that the December is generally when they have the lowest inventory. Okay, so I know I'm comparing like the lowest period, but I don't care. We lost all of our inventory. So I went and I looked at states. What states had, and there was a couple that are like 200 units off, and I don't even care. I just added them because it's only 200 units off. It's like there. So I went back and I was like, okay, how many states are over 2019 December? And I found for whole states, okay, I thought it was 3. I thought it was Texas, Florida, and Arizona. It was 14 states. Go to the Discord group. I sent a picture of all the states. Now, I love the Discord group. So in the group, Charles immediately was like, yeah, but that's December. I was like, I know. I was going to type. And I was like, Brian, Charles, I'm like, now what I'm going to do, now that I know that there's 14 states that have more inventory than pre-COVID, 14, now I'm going to go back and see of those states, which of those states has more inventory than April of 2019. So we're doing a 5-year comparison. How many states do you guys think had more inventory than April 2019? That's before COVID. How many? Okay, I thought it was 2. Texas and Florida. That's all I thought it was, Texas and Florida. I'm going to show you guys right now. Okay, it was 6 states. Starting with, what state is this? Texas. Okay, so here's Texas. Let me put the 5-year view. Okay, so here's the 5-year view of supply for Texas. Let me go back to supply. This is median sales price. Where is it? Here we go. Okay, here's supply. 5-year view for supply. Okay. So 5 years ago, April 2019, we had 131. You guys see down here, it will say the inventory. So April 2019 in Texas, we had 131K units. Right now we have 145K, which means we have a 5-year high of inventory in Texas. Okay. Again, there's 6 states. I only thought there was 2. State number 2, Florida. Okay, homes for sale. Let's go back to April 2019. 195K for sale, April 2019. I mean, Florida, the growth of inventory in Florida, I guess speculation is a real thing, huh? You guys, look at the trajectory. No, it's like, is anyone buying in Florida anymore? Florida also has more right now than April 2019. Again, right now they have 198. During the April 2019, they had 195K. So that's 2 states. 3rd state right here, Oklahoma. Okay. Now, is Oklahoma, let me see real quick. Yeah. So Oklahoma is 150 off, but April 2019, Oklahoma had 16.6K. Right now they have 16.4K. So Oklahoma is only 200 units. I'm just going to say that's included. I mean, come on, guys. We got Fred erasing data. You're going to hassle me on 200 units? Seriously? You guys, Oklahoma's another one. Oklahoma, that's 3 states. Here's the 4th state right here, okay? New Mexico. New Mexico, back in April 2019, had 3,700 units. Fast forward to today, they now have 3,900 units. You guys getting it? That's 4 states with more inventory, not just pre-COVID. No, more inventory than the spring home buying season of 2019. Do you guys get it? It's more than pre-COVID now. It's more than that. It's comparing these seasonality trends now. And that was buying season. Let me show you guys the 5th state. This one's crazy, guys. Here's the 5th state right here. This is Louisiana. Okay. Louisiana back in April 2019 had 11.5K listings. Right now they have 15.4. Louisiana is oh my God. Louisiana, a lot of stuff going on in Louisiana. I mean, like, look at this. You know what's so crazy about this? If I brought up New Jersey is going to show the opposite of this. So like What happens to New Jersey? Is New Jersey going to be forever locked? I mean, isn't this crazy? All right, so the sixth state. Any guesses on the sixth state? So we have one more state. I just showed you guys 5 states with more inventory than spring home buying season pre-COVID. Oh my God. Okay, the sixth state, South Dakota. South Dakota, I'll show you. South Dakota, April 2019 had 2,100 units. Fast forward to today, they have like 50% more units at 3,300. South Dakota. Come on, guys. Did y'all know that? We're coming to the wall right now, man. I mean, we're coming to the wall. You know, we got to get through that election, I think, but I understand the bulls' narratives. Like, I really do. I get it. Like, and another thing that Logan said I found interesting is credit expansion. So, like, when I'm talking to these people, like, I go back and I look at all the data and I formulate an opinion and it gets stronger. I'm like, I appreciate what you guys said because I'm looking at that now. And because I don't want to lead the people of real estate mindset, or even not lead, but kind of guide people in the wrong direction. And really the right direction, and the direction that people that are watching these videos should be taking, is your own direction. You should be trusting yourself, not me. If you want to trust, I'm going to just say, don't trust me. But if you want to, verify what I'm saying. Because if you're doing it to me and you respect me, then you will do it to your realtor. So do it to me. Verify. Even me, verify everything I'm saying. Don't trust me. Don't let me do the thinking for you. That really scares me. Anyways, we're going to go on to our next video real quick, you guys. That was our real estate update right there. Oh my gosh, I'm running late. I have to be done in 25 minutes and I have to go. So this is stupid. This next one right here is a real estate expert is going to tell us how to make money. But he's no expert, you guys. I'm going to be honest with you. But I want you guys to listen to what this guy's saying. Okay, let me do my timestamp live. Let me know if the audio is okay, if you guys can.
Real estate, still say
what?
hoarder house, ugly architecture, and
I believe
even
they just
haunted
did me like
properties
that.
will buy.
They just threw up a commercial when I was about to play this. Oh my gosh. Okay, hold on. I got to duck down under my camera because I can't see. Okay, I got you guys. I'm so sorry. Here we go.
Still say real estate as the best long-term investment. Perfect time to bring in Mitch Rochelle, who just happens to be a real estate expert and a man involved in the real estate business. And I'm no doubt that you will agree with that real estate is by far and away the best long-term investment. You've got to say that.
I'm going to give a really long-term horizon. So if you think about this sort of historically, there are 2 ways that wealth has been accumulated on this planet. One is precious metals, okay, that's going back into like ancient times. The precious metals basket is now where all of your trading assets are, stocks, bonds, stuff like that. The other way is real estate. Well, 2 things have been proven to happen over time.
What about working?
In times of
working,
uncertainty,
one of those things too. Working.
In a time of uncertainty right now, people tend to rotate into the safest assets in that basket. So in that precious metals basket, what are they doing? They're actually rotating to precious metals. Look at metals, gold, silver, and so forth, even Bitcoin. If you look at the real estate basket, what happens is in times of uncertainty, people tend to get out of stocks and bonds and trading assets and get into real estate. So if you literally look at this historically over centuries, you will realize that real estate is the safest place for people to be. And I'll give you a case study. What happened in 1999 when the control of Hong Kong changed? What did the Hong Kong Chinese do? They bought Vancouver. They bought every piece of real estate they could in Vancouver. Why? Because it was a time of uncertainty and they wanted their wealth in a physical asset, and the best physical asset is real estate. So that's why I'll tell you, if you look at stocks and bonds over the short term, they may outperform real estate. But if you look at it as a wealth accumulator over time, you'll find that the average investor will want to have investments in real estate.
Okay, what do the bulls leave out when they say that? What do they leave out? Yes, inflation wedge, 10 years always goes up. But what is this guy leaving out? And actually, every single person that compares what's going on right now to any time in past history, what are they leaving out, guys? The PE ratio. They're not talking about the prices, the price to income. Every one of them leaves it out. Back in the 1999, like he's talking about, what was the PE ratio? 4? It's almost double right now. Because of why? Prices. That's why investor purchasing is going down, not up.
Just not sure that young people see it that way. I'm not sure they think that getting into a house and building the equity is the way to create wealth. They see it another way.
I don't think young people today think about wealth accumulation the way you and I would have thought about
because you
wealth
robbed us
accumulation
of
when
it.
we were that age. So I don't think you can apply my standard to that because they're not thinking in terms of accumulating wealth. However, they definitely want a home because there's this entire industry of people who can't afford to buy one. And what do? They rent a home. There's a whole single family real estate market that is rental. Because people want the backyard, they want the driveway, they want a barbecue grill. So I do think that the home is important to young people. Their challenge is being able to buy one.
They should make the tax break better.
I 100%
That would
agree
really
with you.
help.
Yep.
There's a new report. It's from Fitch Ratings. It reveals that homes are, they say, overvalued by about 11% in most of the United States.
11
In fact,
only?
they picked out 5 states where they say it's most overvalued. Those states are, let's see, Tennessee, Arkansas, South Carolina, Montana, Alabama. Okay, most.
Wow.
How do you figure out what's overvalued? I don't get it.
I don't get it either. The only way I could figure out a metric for a home that was overvalued, if homes are selling for, you take the reproduction cost of a house. What does it cost to build a new house versus what they're trading for? And if there's a big gap, then you could argue that they're overvalued. Okay.
What?
However, most.
No, did you guys see what I'm talking about? This guy's absolute garbage. What about the PE ratio, brother? What about the equity run up in 2.5 years, not matching income? What about the national payment to income ratio? I mean, I'm done with this guy, guys. What do you think of him? I wanted to put him up there. I thought I could handle it. I could not. I apologize. Man, I can only take so much of it. Let's go into our recession and liquidity indicators right now. We're going to start with the yield curve inversion. Now, remember, this is one of the most reliable forecasts of a recession. This takes in, okay, first of all, people look at multiple factors when looking at recession. But this here is like all of those factors, essentially, not all, but a lot of those factors into one data set. That's why people look at this and talk about this so much because, again, it's the most reliable. Hold on one second. I'm so sorry. It's one of the most reliable forecasts to a recession, and it's getting deeply inverted. So we were stuck at 30 basis point inversion for the longest time, but we are almost breaking 50 basis point inversion. Remember, we first got inverted April 1st right here of 2022, which means we've been going through inversion for what, guys? 2 years and 2 months. I think we're at a new record now, which makes sense because of the money printing. So again, if I'm going to flip flop and say it's time to buy, I was wrong about the housing market. It's not going to crash. This needs to uninvert. I need to see income growth and I need to see inventory sustained and no price decline. Okay. But I'm not seeing that. I'm still seeing this huge forecasting set of data. This is the most reliable set, not the talking heads, not me, not CNN, not Fox News. It's this. This takes into so many factors. But again, it's forecasting. This is not going to lead us into recession. This is a forecast. It's a warning. Now, the other problem is, guys, is the liquidity. The inflation's still there. We see it right here. This is real bad. This is the overnight reverse repo market. I was wrong. I thought by the end of this month that we would have zero. And the reason I thought that is I basically did an equation and I calculated the rate of decline. So I think it was from right here to right here. So I calculated this decline and then I added 45 days. So I was like, okay, I'm just going to push it out more because I know how this crap works. And I pushed it out 45 days. And that's why it's to the end of this month. But the money has been stuck. This is so bad because this here is what we don't want. This is inflation. This is part of the reason why there's still so much pain in the markets. There's still so much money. There is, you guys, there's still inflation, money, inflation. Look at this. This is very bad. This would suggest that let's hike some rates. Let's do a little bit of rate hiking. I think we should do another quarter basis point rate hike. Let me know what you guys think. But this money is not leaving the reverse repo market. Now take a look at M2. This is another issue. This is also inflation. Okay. M2. Now this has only been recent, but since about the end of February, M2 has been going up. That's not what we want to see with quantitative tightening with these higher interest rates. This is inflation. So again, you see more inflation. This is so bad. This is so bad because like we got to vote for change because the politicians, I don't care what side you're on, they don't give a crap about us. And they know there's not enough people that care that will make change. I repeat, there's not enough people that care that will make change. And that is so, I don't know what's more depressing to me, what they're doing to us right in front of our face or the fact that not enough people care. It's like equally depressing to me. But then you ask, well, what do you do about it? Well, you can vote or you can teach people. I'm sorry, you could be elected or teach people, and there's no way in hell I will ever try to be elected for anything. Now, let me show you guys the bubble and just how bad the affordability is. This is CPI. Okay, so CPI is on the bottom, it's the black line, and the top line is the red line. That's the Case-Shiller Home Price Index. And I want to show you guys a few things. Now, first of all, there was three recessions, Dave Ramsey, that led to price decline. Okay, so let's just not talk about the GFC. GFC is right here. Okay, first of all, you see how these two really gapped and the unaffordability kind of ravaged us, and then that went down. But home prices also went down in the 1990s. This is the home bubble of the 1990s, by the way. So again, on average, home prices went down 7% in the 1990 recession. So, and you guys want to know where I just did a video for you guys on that, and I got it from, you want to know where I got this from? Like an idea to go back to 1990s from Logan the Bull. He threw up some data. I was like, oh my God. All right. It shows price decline in 1990s. Let me explore why was there price decline in the 1990s, but not 2000. You guys see my point? You guys see my point here? But anyways, guys, this is very interesting. But we did lose value in 1990s. I just did a video on that, so I hope you guys like that. Let's keep going here. Now, data corruption. Okay, so they just removed and erased from history new home prices declining. That's been erased from history. It's gone. Okay, and I want to read this special note, and then I'm going to read another special note. Okay, here's the special notice. Beginning with the release, the sales price range in groups in Table 2, new privately owned housing sold by sales price has been updated to better reflect the current distribution of new home prices. So after that alone, I'm like, nothing else matters. Because to me, what that says is we don't like what it shows, and we're going to show different information. We're going to show different information because we don't like what it's saying. And then they go into like what they're doing. And it's just, you guys can read this if you want. I'm not going to waste my time or your time. It's that first little section that hurts me. And did you guys know that the new home data is just from a survey? Did you guys know that? We don't even have an ability to track what's going on in new construction. Did you guys know that? It's just a freaking survey. And guess who fills out the survey? The builders. Don't the builders want to make their shareholders happy? And look at this. Okay. And not only that, I mean, this says here that there's going to be biasness, that there's sampling errors, but only 76.6% of participants respond. That means we are missing a minimum of 23% of the data. Mic drop, boom. How do we know what's going on? How could we possibly know what's going on when there's no accountability? It's just a survey. There's no accountability. How is this possible? How is this possible? We have this horrible crisis. How is that possible? You guys, I got one more video for you, and then we're going to kind of just make our way out here. Let me tee this last video up. Hope you guys enjoy.
Last year, but new data shows there are a few
financial giants and banks thought you wouldn't notice. But the rollout of the spot BTC ETFs signaled the rise of the digital dollar and CBDCs. Now,
a few exceptions. The Sun Belt is now seeing some of the biggest rent declines in America, with Austin, Nashville, Jacksonville, Miami, San Diego, Phoenix, all seeing lower prices. Joining us now, Howard Hughes Holdings CEO David O'Reilly. So, David, that's your area, right? You're the Sun Belt guy.
Absolutely.
And everybody talks about wanting to be in the Sun Belt. Mm-hmm. But rents are falling. Now, you say that's demand is still great, but I don't know. The falling rents tells me maybe something else is going on.
Well, I think demand is very strong, continues to be very strong. I think the shift in rents is being driven by supply. Developers move in a herd mentality. 2 years ago, post-pandemic, everyone's moving to Florida. Rents in multifamily are up. Everybody got their shovels and started digging. And now those units that we talked about 2 years ago are all hitting at the exact same moment in time. And as a result, rents are going to fall. Consumers, renters are going to get a great deal for now. 2 years from
that
now.
for now sounds like
Right, because you and I are talking about rents falling. The herd developers have taken their shovel and left. They're gone. So those units that should be delivering in 2 years from now to help meet the continued demand into the Sun Belt won't be there. And I think rents will come back up at that point in time.
What do you mean by a flight to quality?
It's about quality of life at the end of the day. It's about affordability. It's access to nature. It's walkability. It's short commutes to work.
Man, these guys are smooth.
Better weather.
Smooth.
And those are the type of things that the Sun Belt has offered. Communities that we have, like the Woodlands outside of Houston or Summerlin outside of Las Vegas, have been a huge beneficiary of this flight to quality. People that want quality education, time with their kids, short commutes, low taxes, business-friendly environments.
Low
And
taxes.
it makes a lot of sense. I think the pandemic was the
don't have
main
low
driver
taxes.
of that. But what you're talking about, the supply-demand imbalance, is why the market is so skewed right now in general. Why is it that developers can't provide a more consistent amount of supply and stream it, periodically and timed out so that we don't have these huge fluctuations in pricing?
That's exactly what we do at Howard Hughes, because we're the master developer of huge communities. 28,000 acres in the Woodlands, 37,000 in Phoenix, in an area called Terra Vallis. In every other city, each corner of the intersection is owned by 4 developers. And when the market's good, all 4 of them are raced to be first. One of them wins, one of them ties, and 2 lose, because the market turns and then they're in a race for 0 competing with each other. And I think that's the problem, is that it's very difficult in communities that don't have that overarching master developer like you would at Howard Hughes to limit supply appropriately, not to get too far ahead of their skis.
But you're building these massive developments, and all everybody can think about is, I don't want it to get a mortgage and buy into this environment because it's too expensive. So who the heck is buying these things? How are they financing it? How are you making this happen?
This has been a remarkable time for home building, because we have great demand coming from your first-time home buyers, which are average age 35 years old. 11,000 people turn 35 every day.
Cranberry eater.
Retirees, average age 65, that are very wealthy with a 40-year run of housing equity built up.
So they don't need the big mortgage. They've got cash.
Even if they do, they're buying new construction, because the resale market is non-existent as homeowners are locked into below-rate mortgages. And the large...
Not non-existent, except into the 14 states that have more inventory than lockdowns. So, whoops.
National home builders, both public and private, have the ability to buy down your rate. 150, 250 to 200 basis points,
that is true.
Making it more affordable.
Just quickly, about 20% of your business is commercial. How is it going?
It's going very well. Because we don't have that oversupply issue within our communities. Our office portfolio this past quarter, we just reported earnings last week, was up double-digit year over year. Our multifamily portfolio was up 9% year over year. When you can limit supply and just build to meet market demand and not build for building's sake, you're going to reap the rewards throughout all points in the cycle.
We gave you the...
Okay, so that means no speculation. But that's not true. They're going to speculate. Let me, we're about done, you guys. I just want to do a couple more things here. So I just wanted to end here. Remember, you guys, it depends on a market, because in my market here in Houston, I find all kinds of crazy deals. But I just wanted to put as an example, here's Houston right here. This is Lennar. Obviously, there's price cuts all over the place for new home builds. But what matters is, again, what's going on in your market. I'm just showing you guys some resources, price cuts, slashing, gashing, gutted. Oh my gosh, if they're doing so well, why are they slashing the price? That's a $50,000 price cut right there. A lot of price cuts. This one, oh my gosh, that's $74,000 price cut right here. But not only that, you guys, not only these price cuts, look at what they're offering. This is Lennar in my area, fixed rate, FHA fixed rate of 4.5%. What? Honestly, it's been like that for 2 years. It's nothing special, to be honest with you. And 50% off earnest money with a $40,000 price reduction on select homes. Also, I wanted to end here, you guys. We did make a new channel. This is called Doomers News Network. This is a channel that Melody, Jack, and I have made. And what we plan on doing is basically having like really long lives. Our next live is going to be on Sunday at the same time. So if you guys are interested, we're going to basically cover a whole bunch of stuff, not just real estate. We're going to cover all kinds of stuff like stock market stuff, obviously try to get guests on. But this is really cool. If you guys don't have to come here. But the way it works again is we're just doing, for now, because of being overwhelmed, one live, very, very long live. And then what I do is I go back and I edit the segments of the live. So if you can't watch a 3-hour or 2.5-hour live and you just want the segments, I've edited those out right here for you guys if you're interested. And other than that, I I'm ready to go fishing, you guys. I'm ready to go fishing. I'm not surf. I'll be back on Friday, but wish me luck. Give me some prayers. I will be praying for you guys. I love you. I'm proud of you. Keep working hard. I know it sucks, but it will be worth it at the end. And I really appreciate you guys and supporting me. I hope I'm supporting you just as much. Now, if you're out there investing in real estate, you guys already know that I wish you luck and I hope you win.